There is a point in every civilization where debt stops being a financial issue and becomes a mathematical one, not a crisis of confidence, not a failure of leadership, a failure of arithmetic, when the promises written into the system exceed what the future can physically produce. The outcome is no longer a choice. It is a sequence. It has already happened 5 times over the last 2,000 years, and each time the ending looked different, but followed the same structure. Today, the numbers tell us we have entered that structure again. This is not a forecast. It is a phase that has already begun. To understand what comes next, you have to see the pattern from the beginning. Because every debt collapse begins the same way, not with panic, but with optimism. Credit expands quietly, presented as progress, framed as growth, and justified as an investment in the future. Borrowing accelerates because it appears to work. Spending rises. Asset prices increase. Governments point to expanding GDP as proof that the system is healthy. But this phase is not prosperity. It is leverage masquerading as stability. Debt is not wealth. It is a claim on future production. When an individual borrows, they are committing future labor. When a government borrows, it is committing future taxpayers. As long as future production grows faster than debt, the illusion holds, and the danger emerges. When debt grows faster than the system's ability to produce real value, this is the first stage of the recurring pattern. Credit expansion creates the appearance of prosperity while silently transferring risk into the future. In ancient Rome, the pattern began after Augustus consolidated imperial power. Between 10 and 30 AD, Roman credit markets expanded rapidly. Wealthy patricians lent aggressively to merchants, landowners, and even to other members of the elite. The Senate authorized massive public spending programs funded by borrowing. Roads, aqueducts, public buildings, and civic monuments spread across the empire. Rome appeared to be flourishing, but the borrowing was not directed toward productive innovation. It funded consumption, spectacle, and political competition. Senators borrowed to finance gladiatorial games. Governors borrowed to bribe their way into office. Private households borrowed to maintain social status. By 20 AD, many elite families were borrowing, not to grow wealth, but simply to preserve appearances. The economy expanded, but the expansion was hollow. Debt supported spending that did not generate future income. The system mistook motion for progress. The same structure appeared in medieval Europe after the agricultural boom of the High Middle Ages. Between 1300 and 1340, credit became widely available through powerful Italian banking families such as the Bardi, the Peruzzi, and the Medici. These banks lent to kings, nobles, merchants, and even the church. Sovereign borrowing exploded. Wars were financed through loans rather than taxation. Edward III of England borrowed more than 1.5 million florins from Italian banks to fund the 100 Years' War. That sum exceeded his kingdom's annual revenue. Yet the system continued because trade expanded. Cathedrals rose, universities were founded, and money circulated. Prosperity seemed real. Underneath, the debts compounded. Monarchs borrowed to service previous loans. Banking houses became dangerously exposed to sovereign defaults. The appearance of growth masked a structural imbalance that could not be sustained. Revolutionary France followed the same path. After decades of war under Louis XIV, the French state was deeply indebted. Instead of reducing obligations, successive governments borrowed more. Louis XV financed wars across Europe through debt. Louis XVI inherited a system where interest payments consumed roughly half of government revenue. Paris remained a cultural capital. Versailles radiated wealth. Credit continued to flow because France was assumed to be too large, too powerful, too wealthy to fail. The expansion of debt delayed collapse, but it did not prevent it. The pattern repeated again in Weimar Germany after the First World War. Reparations imposed by the Treaty of Versailles had totaled 132 billion gold marks, an impossible obligation. Rather than confronting the burden directly, the German government borrowed domestically to meet payments and fund reconstruction. Employment rose. Output increased. The illusion of recovery returned. But the money was not real growth. It represented future claims Germany could never satisfy. Debt substituted for productivity. After the Second World War, the Western world entered the largest credit expansion in history. The United States introduced the GI Bill, subsidizing housing, education, and business formation. Europe received Marshall Plan assistance, much of it structured as credit. Growth was rapid. Inflation was low. Governments could borrow cheaply. Living standards rose at unprecedented rates. This period is often remembered as proof that debt-driven growth works. In reality, it was the first stage of the same cycle, enabled by unique post-war conditions that would not repeat indefinitely. Stage 1 always feels constructive. Credit expansion lowers friction. It accelerates activity. It creates measurable growth, but it also builds a dependency on borrowing that becomes invisible while conditions remain favorable. Eventually, the system crosses a threshold. Empirical research across centuries shows that when total debt approaches approximately 250% of economic output, growth begins to slow. Resources shift away from productive investment towards servicing existing obligations. Each new unit of debt produces less growth than the one before it. Ancient Rome crossed this threshold by the early 30s AD. Contemporary accounts describe debt as universal and crushing. Senators owed sums they could not repay. Merchants were insolvent. Families with vast landholdings were bankrupt on paper. The economy was fully leveraged against its future. Medieval Europe reached the same point by the 1440s. Edward III owed more than his entire kingdom could generate in a year. Italian banking houses were exposed to defaults many times larger than their capital reserves. Credit markets began to freeze. Interest rates rose. New lending slowed. Revolutionary France crossed the threshold by 1788. Debt consumed 60% of government revenue in interest alone. Total obligations approached 300% of annual income. Borrowing more increased the problem rather than solving IIs. Time, 0.5s. Weimar Germany surpassed the threshold by 1921. Total debt exceeded 400% of GDP. Reparations alone were several times larger than national output. In the modern global economy, this threshold was crossed after the 2008 financial crisis. Instead of deleveraging, governments and corporations borrowed more. By 2010, global debt reached approximately 250% of GDP. By 2020, it exceeded 320%. Emergency spending during the pandemic pushed it even higher. This marks the end of Stage 1 and the entry into Stage 2. At this point, the system is no longer growing on borrowed time. It is consuming it. Stage 2 transitions quietly into Stage 3. This is the phase where debt stops being a future problem and becomes a present constraint. Interest payments begin to absorb the entirety of real economic growth. The system does not collapse immediately. Instead, it locks itself into a trap where survival requires continuously expanding the very burden that is causing the damage. At this point, borrowing no longer funds expansion. It funds maintenance. New debt is issued not to create value, but to service existing obligations. Growth continues on paper, but the surplus disappears into interest. This is the mathematical breaking point of the system. Debt is a claim on future production, but interest is a claim on growth itself. When interest obligations exceed the economy's ability to generate new value, the structure becomes self-consuming. Every additional unit of output is already spoken for before it exists. Ancient Rome reached this stage in the year 33 AD. Creditors demanded repayment. Debtors could not comply. Lending froze. Existing loans were called in. Land prices collapsed because no one could borrow to buy property. Commerce slowed across the empire. Interest on accumulated debts absorbed the productive output of Roman society. Wealth flowed upwards toward creditors, but the debtors had no remaining capacity to produce what was owed. The system seized. In medieval Europe, the transition was just as abrupt. In 1345, Edward III of England defaulted on his obligations to the Bardi and Peruzzi banking. Houses. These banks had lent far more than their capital reserves could sustain. When payments stopped, the institutions collapsed. The failure cascaded across Europe. Without Italian banking networks, international credit disappeared. Trade contracted sharply. Kingdoms that had relied on borrowing for decades suddenly faced interest payments, consuming nearly all state revenue. Economic growth halted. Revolutionary France entered stage 3 by 1788. 60% of government revenue was devoted to interest payments alone. The monarchy borrowed simply to remain solvent. This is the precise definition of a Ponzi structure. New obligations were required to meet old ones, with no path to resolution. When King Louis XVI convened the Assembly of Notables to authorize new taxes, the nobility refused. They were creditors themselves. They would not absorb losses to preserve a system they believed would eventually collapse regardless. The political structure fractured under the weight of arithmetic. Weimar Germany followed the same path between 1922 and 1923. Reparations, domestic debt service, and reconstruction costs exceeded government revenue. The only remaining mechanism was currency creation. The central bank expanded the money supply continuously. Inflation began slowly, then accelerated. Savings eroded. Prices doubled repeatedly. But debts denominated in gold marks grew in real terms even as the paper currency collapsed. The system devoured both debtors and savers simultaneously. In the modern global economy, Stage 3 emerged after the pandemic response. The United States now spends approximately $900 billion per year on interest, approaching $1 trillion annually at historically low rates. If rates return to long-term averages, interest obligations could rise to $1.5 trillion per year. Real economic growth in the United States averages roughly $500 to $700 billion annually. Interest payments already exceed growth. Globally, the imbalance is even more severe, with total debt near $300 trillion and average interest rates around 3%. Annual interest obligations approach $9 trillion. Yet global GDP growth adds only approximately $2.7 trillion of new production per year. The system demands more than it can generate. At this stage, there is no policy solution. Raising taxes cannot close the gap without collapsing demand. Cutting spending reduces growth further, worsening the ratio. Borrowing accelerates the problem. The structure is locked. Stage 3 is the point of no return. Once interest consumes growth, time no longer heals the imbalance. It amplifies it. Every delay increases the scale of the eventual reset. This is where the present system now stands. Stage 4 begins when denial collapses. This is the moment of recognition, when the mathematics become impossible to ignore. The system does not fail because participants lose confidence. It fails because the numbers no longer permit belief. At this stage, everyone who can calculate understands the same conclusion. The debt will never be repaid. Not slowly, not eventually, never. Ancient Rome reached this realization in the year 33 AD. The crisis was no longer abstract. The Senate had attempted to stabilize the system by passing a law requiring 2/3 of every creditor's capital to be invested in Italian land. The intention was to support property prices and preserve collateral values. The result was paralysis. No one wanted to lend to buy land. Debtors were already insolvent. Creditors were overexposed. Prosecutions multiplied. Debtors' prisons filled. Even powerful patrician families were revealed to be bankrupt. Senators owed more than they possessed. The Roman elite itself was insolvent. The debt was mathematically unpayable. In medieval Europe, recognition arrived after the banking collapses of the mid-1440s. Kings attempted to renegotiate their obligations. They proposed partial repayments, extended maturities, and alternative collateral. None of it mattered. England's annual revenue was roughly £100,000. Edward III owed nearly £900,000 to Florentine lenders, even if the Crown devoted every unit of revenue for 15 years. The debt could not be repaid. Creditors understood this. They stopped expecting payment. Loans were written off. The system was functionally bankrupt. Revolutionary France reached the same conclusion by 1789. When interest and basic government operations were combined, debt obligations consumed all tax revenue. The figures were public. Jacques Necker published the accounts in an attempt to force reform. Instead, the data proved insolvency. Even if France eliminated the military, halted public works, and dismissed every civil servant, the debt remained unpayable. The Third Estate demanded default. The aristocracy resisted, because they were the creditors. The system fractured along the fault line between those who owed and those who were owed. Weimar Germany entered full recognition in 1923. By mid-year, the government printed trillions of marks per day. Prices changed hourly. A loaf of bread cost billions. Workers demanded multiple wage payments per day so they could spend money before it lost value. Yet, reparations and domestic debts remained denominated in gold. In real terms, obligations expanded as the currency collapsed. Germany would have needed to produce more value than the entire economy generated simply to service interest. The impossibility was absolute. In the modern, global economy, recognition is now spreading. The United States would need to run budget surpluses of approximately $1 trillion per year for 3 decades, while also paying close to $1 trillion annually in interest, timed and ZARs 0 and 2.5s. That would require either tax increases exceeding 50% or spending cuts approaching 70%. Neither option is politically viable. Globally, total debt of $300 trillion would require repayment equivalent to multiple years of total world economic output while still sustaining daily life, governance, and commerce. The arithmetic does not function. Stage 4 is not collapse. It is clarity. Once recognition occurs, behavior changes. Creditors become defensive. Debtors become political. Trust erodes. The system begins to crack under the weight of truth. This recognition triggers the next phase. Stage 5 begins when mathematical reality collides with political reality. Once a system is recognized as insolvent, pressure does not dissipate. It concentrates. Debtors demand relief. Creditors demand protection. Governments are forced to choose between two groups that cannot both be satisfied. This is where financial crises become social crises. In ancient Rome, the pressure surfaced immediately after recognition. Debtors' prisons overflowed. Families were sold into servitude to satisfy obligations that could no longer be met. The plebeian population demanded relief. Their representatives, the tribunes, pushed the Senate to cancel debts entirely. The patrician class refused. They were the creditors. Their wealth existed in the form of claims on others. Cancelling the debt meant erasing their status. The Senate deadlocked. Riots erupted. Mobs targeted the homes of known creditors. The social order began to fracture along economic lines. In medieval Europe, the pressure took a different form. After the collapse of the Italian banking houses, debtors argued their obligations had died with the banks. Nobles refused to pay kings who themselves had defaulted. The legal framework for enforcement weakened. The debt system began to unravel, but before political resolution could occur, a larger force intervened. In 1347, the Black Death arrived. Within 3 years, between 30 and 50% of Europe's population perished. Creditors and debtors died alike. Labor became scarce. Wages rose. Debt enforcement collapsed, not by policy, but by absence. There were not enough people left to collect what was owed. The plague functioned as a reset mechanism. Debt did not disappear through legislation. It vanished through mortality and chaos. Stage 5 and Stage 6 merged. In revolutionary France, pressure transformed into open revolt. By 1789, the Third Estate, representing the vast majority of the population, demanded that the monarchy default on debts owed to aristocrats and foreign lenders. They argued the obligations had been accumulated through wars that served elite interests. The aristocracy resisted. They demanded higher taxes on the population to preserve their claims. This conflict between debtors and creditors became the central axis of the revolution. The political system could not mediate it. Violence followed. In Weimar Germany, pressure escalated rapidly during 1923. Workers struck. Extremist movements gained momentum by promising to cancel debts and end reparations. Both communist and nationalist factions attracted support. Adolf Hitler attempted a coup in November, explicitly campaigning on refusal to honor external obligations. The government faced an impossible dilemma. Continuing to pay destroyed domestic stability. Refusing to pay risked international consequences. Order collapsed under the strain. In the modern global economy, Stage 5 is now forming. Political movements across the spectrum demand debt relief, student loan forgiveness, mortgage forbearance, corporate restructuring, and sovereign debt jubilees dominate public discourse. One side argues that lenders exploited borrowers. The other argues that inflation is theft and that savers are being sacrificed. Governments respond with partial measures, stimulus payments, loan forgiveness programs, emergency spending. These actions relieve pressure temporarily, but they do not resolve the imbalance. They redistribute losses without eliminating them. The social contract weakens. Stage 5 is defined by polarization. The system becomes unstable, not because it lacks resources, but because it lacks consensus. Every solution creates a new conflict. Every delay increases tension. At this point, history offers no examples of reversal. Pressure continues to build until the final phase begins. Stage 6 is the reset. This is not reform. It is not correction. It is destruction of the existing debt structure. History shows that once Stage 5 is reached, there are only three mechanisms through which the system resolves itself. The method changes. The outcome does not. Debt is erased. The first method is hyperinflation. Governments expand the money supply beyond control. Debts are repaid in currency that no longer holds value. Creditors receive payment in name only. Savers lose purchasing power. The system survives on paper while collapsing in reality. Ancient Rome followed this path gradually. After the crisis of 33 AD, Emperor Tiberius attempted a partial intervention by releasing 100 million sesterces from the imperial treasury as interest-free loans. Debtors repaid creditors using public funds. The state absorbed private losses. Relief was temporary. Within decades, Roman emperors began debasing the currency. The silver content of the denarius declined steadily. By 200 AD, it was half silver. By 300 AD, it contained less than 5%. Inflation eroded debts. Creditors were repaid with diminished money. The reset occurred slowly, disguised as continuity. The second method is jubilee. Debt is cancelled directly through political agreement. Creditors accept losses so the system can continue. Post-war Europe provides the clearest example. After the Second World War, West Germany faced debts exceeding its economic capacity. In 1953, creditor nations convened the London Debt Agreement. Roughly half of Germany's obligations were cancelled outright. The remainder was restructured with low interest rates and long repayment schedules tied to economic growth. This was not generosity. It was necessity. Creditors understood that enforcing full repayment would recreate the conditions that had produced hyperinflation, extremism, and war. Losses were absorbed to preserve stability. The system reset through negotiation. The third method is war. Physical destruction replaces financial resolution. Capital is destroyed. Populations are reduced. Records disappear. Debts become unenforceable amid chaos. Medieval Europe experienced this through plague rather than policy. Between 1347 and 1350, mass death erased obligations without legislation. The feudal debt structure weakened. Labor scarcity shifted power. The system reset through catastrophe. The modern global economy has not yet completed Stage 6, but the pattern is advanced. Stages 1 through 5 are complete or nearly complete. History shows that Stage 6 typically follows within 3 to 7 years of Stage 3. The present system entered Stage 3 around 2020. That places the window of resolution between 2023 and 2027. The most likely path is not immediate collapse. It is prolonged inflation. Persistent price increases of 10 to 20% annually over a decade quietly erode the real value of debt while preserving the illusion of repayment. Time 0.5s. Partial jubilees emerge alongside inflation. Select debts are forgiven. Others are inflated away. War remains the most dangerous variable. When political systems deadlock under unpayable obligations, conflict has historically provided the final release. When the reset arrives, wealth does not vanish evenly. It transfers. Savers lose. Fixed incomes erode. Creditors are repaid with diminished value. Debtors benefit. Hard assets retain function. Real estate, commodities, productive enterprises survive currency destruction because their value is rooted in utility rather than denomination. This pattern has repeated 5 times over 2,000 years. Each time, the structure differed. Each time, the stages aligned. Each time the debt was erased. The present numbers show the same sequence in motion. The question is not whether the reset occurs, it is whether it is recognized before completion. After every reset, the same question emerges. Who lost and who survived? History shows that debt destruction does not affect all participants equally. It redistributes wealth according to position, not effort or intent. The mechanism is mechanical. Those who held claims on the system lose first. Cash savings lose purchasing power under inflation. Bonds deliver fixed payments that collapse in real value. Pensions and annuities lag behind rising prices. What appears stable on paper decays quietly over time. Fixed incomes are eroded without default. Payments continue, but they buy less each year. A lifetime of savings becomes insufficient, not because it disappears, but because it no longer functions. Creditors experience the same outcome through a different path. Debts are repaid, but in diluted currency. 100 cents on the dollar returns, yet each dollar represents a fraction of its former value. The contract is honored in form and broken in substance. Debtors experience the opposite effect. Fixed-rate obligations shrink in real terms as prices rise and incomes adjust. A mortgage, a business loan, a long-term liability becomes easier to service as currency weakens. What was once a burden becomes an advantage. Hard assets behave differently. Property retains utility regardless of denomination. A house remains shelter. Land remains productive. A factory continues to produce. Their value is not tied to the unit used to measure it. Across every reset, these assets persist. This is why the pattern favors positioning over prediction. The reset does not arrive as a single event. It unfolds across years. Those who recognize the structure early adjust gradually. Those who trust stability adjust too late. The present system displays all historical markers. Global debt exceeds 300% of output. Interest consumes growth. Recognition has spread. Political pressure has intensified. Partial relief measures are already in motion. The sequence is intact. Ancient Rome absorbed private debt through public balance sheets, then inflated it away. Medieval Europe lost its debts through mass death and institutional collapse. Revolutionary France destroyed obligations through hyperinflation. Weimar Germany erased debts in a single year of currency failure. Post-war Europe negotiated cancellation to prevent repetition. Different centuries, different tools. Same result. Debt does not get repaid when it becomes unpayable. It gets erased. The current phase is not unique. It is familiar. The numbers align. The stages match. The outcome follows gravity, not opinion. Understanding the pattern does not prevent the reset. It only determines whether one is positioned before it completes. History has already answered what comes next. Every time this pattern completes, the same mistake is made. People assume the present moment is unprecedented, that the scale is too large, that modern institutions are too sophisticated, that technology, policy, or coordination will break the cycle. History shows the opposite. Scale does not prevent collapse. It accelerates it. Complexity does not stabilize systems. It increases fragility. The more interconnected the structure becomes, the faster stress propagates once thresholds are crossed. The modern financial system is the most complex debt structure ever created. Sovereign debt layered on corporate debt layered on household debt, derivatives built on top of obligations that already exceed productive capacity. Time divides 0.5s, central banks acting as buyers of last resort, not to stimulate growth, but to prevent immediate failure. This architecture did not eliminate the pattern. It compressed it. In previous cycles, information traveled slowly. Recognition unfolded over years or decades. Today, balance sheets are public. Debt ratios are transparent. Interest costs are observable in real time. The recognition phase spreads instantly. Markets react faster. Political responses lag further behind. This creates a new dynamic. Volatility replaces stability. Policy loses credibility. Confidence erodes not because people panic, but because arithmetic becomes common knowledge. Once that happens, trust no longer anchors the system. Expectation does. Inflation becomes embedded. Asset prices disconnect from wages. Credit allocation distorts further. Governments choose delay over resolution because resolution is politically fatal. Each intervention buys time at the cost of magnitude. This is why late-stage debt cycles feel prolonged and confusing. Nothing breaks cleanly. Everything degrades. The reset does not announce itself. It emerges through normalization. Higher prices become permanent. Emergency measures become standard policy. Temporary relief becomes structural dependency. By the time the reset is obvious, it is already complete. The current phase reflects this progression. Inflation has not returned to historic norms. Interest rates remain elevated relative to growth. Debt continues to expand faster than output. Political consensus has fragmented. Partial relief has replaced reform. These are not signals of recovery. They are markers of transition. History does not require belief to function. It only requires alignment. The sequence that erased debt 5 times before is no longer theoretical. It is active. The final stage does not arrive suddenly. It arrives gradually. Then, all at once. Those who understand this pattern do not wait for confirmation. They recognize that confirmation arrives after positioning is no longer possible. This is not the end of the system. It is the end of this structure.